Hello and welcome. In this presentation, we're going through critical details on the SRA Accounts Rules 2019, an essential part of the SRA standards and regulations, and, like the codes of conduct, rules of professional conduct. Solicitors must comply with these rules and can be disciplined for breaches, as they are principally aimed at protecting client money. The rules apply to you, which includes all authorized bodies such as law firms and alternative business structures, as well as managers and employees of those bodies, including partners, solicitors, trainee solicitors, and paralegals. This presentation was prepared by Dr. Yannis. If you would like to know more about how it was produced, please get in touch with Dr. Yannis. Let's continue. A solicitor will receive, hold, and manage money which belongs to others, referred to as client money in the rules. This money includes amounts belonging to clients and third parties, basically any money not belonging to the solicitor or the firm. Most firms maintain at least one client account, often a general client account into which the majority of client money is paid, plus possible separate designated client accounts for specific matters. Any client account must be with a bank or building society in England and Wales, and must include the word client in its name, to protect the funds in case the solicitor becomes insolvent. A solicitor need not maintain a client account if the only client money is in respect of the solicitor's fees and certain disbursements, though this is useful only for a limited number of firms. A solicitor may also decide not to operate a client account by making arrangements with a third-party managed account (TPMA) provider. When client money is received, it must be paid into a client account promptly, unless specific exceptions apply. Client money must remain available on demand, so it should be held in an instant access account. Any unused client money should go back to the client as soon as there's no proper reason to hold it, usually at the end of the legal matter. A solicitor must not provide banking facilities via a client account, meaning all client money held must be tied to a regulated legal service with a proper underlying connection. Solicitors are not banks, and the practice carries insolvency and money laundering risks. Solicitors must keep client money separate from money belonging to the solicitor using a separate client bank account. There are limited scenarios where client money may be paid into a firm's business account. For instance, if a mixed receipt arises that includes client money and the solicitor's money, and that receipt is allocated to the correct account by a subsequent transfer. A solicitor may only transfer client money to pay fees and unpaid disbursements after a bill has been issued, but money covering a disbursement already paid by the firm is not client money and can be transferred earlier.
Withdrawals of client money must be authorized and supervised properly. A solicitor should not pay out client money on a client's behalf unless there is enough held for that client. Breaches of the rules must be corrected promptly upon discovery, including replacing client money that was improperly withdrawn, using the firm's own business money if necessary. A solicitor should account for a fair sum of interest on money held for a client. The rules require the solicitor to maintain accurate, contemporaneous, and chronological accounting records. These include separate client ledgers, a list of client ledger balances, and a cash book of all client account transactions. Bank statements must be obtained, and reconciliations carried out at least every 5 weeks, while a central record of bills issued must be kept. Not all client money is necessarily in client accounts. A solicitor might hold a joint account with a client, or operate the client's own bank account as a signatory. Alternatively, the solicitor may set up arrangements with a TPMA provider. Most firms must obtain an accountant's report within 6 months after each accounting period if they hold client money or operate relevant accounts, unless only small sums of client money were held or if all the client money came from the legal aid agency. Any qualified accountant's report indicating serious or persistent breaches must then be delivered to the SRA within the same 6-month time frame. Accounting records and basic transactions. Let us focus on the bookkeeping aspect. Like any business, solicitors' firms rely on double-entry bookkeeping. This centuries-old method requires 2 entries for each transaction, one as a debit and one as a credit. These entries are made across various ledger accounts, reflecting different areas of the practice such as costs, VAT, bad debts, or petty cash. Cash account ledgers note all receipts and payments through the business bank account and client bank accounts. Each client matter has its own client ledger to track amounts owed by the client and amounts owed to the client. Both the cash account and the client ledger contain distinct columns for business money and client money. When funds are received, a debit entry is made in the relevant cash account, with a credit entry in the client ledger. Receipts often combine both client money and business money, especially since most are now electronic. Mixed receipts usually go into the client account, and any portion belonging to the solicitor, the business money, is then transferred out. When money is paid out by the solicitor, a credit entry is made in the relevant cash account and a corresponding debit entry is recorded in the client ledger. As good practice, solicitors seek money in advance for costs and disbursements. Transfers between accounts can be actual cash transfers from one bank account to another, for instance, client to business account, or nominal transfers from one client ledger to a different client ledger, moving the liability record without moving cash. Costs and disbursements, payment of interest and other transactions. VAT is levied on goods and services, and that includes a solicitor's professional services. Currently set at 20%, solicitors collect VAT from clients and pay it to HMRC, typically on a quarterly basis. The VAT charged to clients is known as output tax, while VAT paid on business goods or services is input tax. By offsetting input tax against output tax, a solicitor can reduce the overall VAT payable to HMRC. Issuing a bill prompts entries in the client ledger, the costs account and the VAT account, but no immediate cash account entry occurs because no money changes hands at the billing stage. The bill can be paid using money from the client account via transfer to the firm's business account, or by the client paying separately if there is no client money held. If the solicitor decides to reduce a bill in the interests of client relations, it is known as an abatement, and the reverse entries of issuing a bill will be made. Sometimes a client cannot settle the bill, prompting the solicitor to write off the debt. The way this is recorded depends on whether VAT bad debt relief is available at the time. VAT applies to certain disbursements like counsel's fees, but not to others such as court fees. A disbursement is only treated as a disbursement for VAT if it's passed on to the client without comment by the solicitor. If the solicitor advises on it, it becomes part of the firm's professional services, which may require charging VAT on it separately. If the invoice for a disbursement is addressed to the client, the agency method typically applies, meaning no separate VAT accounting is required. However, if addressed to the solicitor, then the principal method applies, with the solicitor treating the cost as input tax and billing the client for it with output tax. There is a concession for counsel's fees. The agency method can be used if counsel's fee note is amended. When holding client money, a solicitor must consider whether to pay interest. If the money is kept in a separate designated client account, the actual interest earned goes to the client. Alternatively, if it is in the general client account, the solicitor pays a sum in lieu of interest. Importantly, solicitors should not provide banking facilities. Client money must be linked to legal services, and it should be instantly accessible, ruling out higher interest deposit accounts that have notice periods. Many firms have a de minimis policy that can eliminate the need to pay small amounts of interest. Although electronic transfers are standard, some checks remain in use. A solicitor must be cautious about drawing on client funds before a check clears to avoid inadvertently using other clients' money if the check is dishonored. Any breach must be remedied immediately upon discovery. A small amount of petty cash is usually kept on hand in notes and coins for minor business expenses like postage. Petty cash rarely features in the client ledger. Any breach of these rules, often stemming from wrongfully withholding or withdrawing client money, must be promptly corrected by putting business money back into the client account. Details on the SRA's Solicitor's Account Rules. This chapter addresses the knowledge required for the SQE assessments regarding solicitors' accounts and client money. We'll explore the definition of client money, the obligation to pay it into a client account, and the situations that allow withholding client money from that account. We'll also clarify what a client account means, how its name must include the word client, and why it can't be used to provide general banking services. The rules mandate separate handling of client money from the firm's business money and the prompt correction of any breaches upon discovery, along with accurate ledger keeping and reconciliation. We'll also note the operation of joint accounts, the client's own accounts, TPMA usage, and how to obtain and deliver accountants' reports. Finally, we'll discuss the storage and retention of these crucial accounting records. We refer to the SRA Accounts Rules 2019, which form part of Chapters 14 to 16 of the SRA Standards and Regulations. They cover the obligations placed on solicitors in respect of their accounts and, importantly, the safeguarding of money belonging to clients and third parties. The focus is on separating the solicitor's business money from client money and maintaining robust systems. Future chapters deal with double-entry bookkeeping, ledger accounts, and typical financial transactions, which you must understand for assessment. though the SQE Stage 1 typically uses multiple choice questions applying the principles. The SRA Accounts Rules 2019 are rules of professional conduct, read alongside the SRA Codes of Conduct. They replaced the SRA Accounts Rules 2011 on the 25th of November 2019. A solicitor can be disciplined or struck off for breaching them, as shown in Weston v. The Law Society, 1998, where a partner was struck off even though he was unaware of the breaches committed by fellow partners. His failure to ensure compliance within the firm was enough. The rules are structured into 4 parts, beginning with general provisions, then client money and client accounts, and so on. The SRA also publishes guidance, found on their website, to help you understand the practical implications. The rules refer to authorized bodies rather than just solicitors, since the SRA regulates other legal providers. The 2019 rules apply to authorized bodies, their managers and employees, and they place joint and several responsibilities on them for compliance. A licensed body or alternative business structure, ABS, might carry out regulated and non-regulated activities, but the accounts rules only apply to the regulated ones. This broad scope means the same fundamentals apply whether you're in a traditional firm or an ABS, ensuring transparency and client protection. Part 2 of the rules: client money and client accounts. This is the largest and most important segment, dealing with managing and safeguarding client money, ensuring it's kept separate from the solicitor's own funds, and restricting the improper use of a client account. Client money covers money belonging to clients and third parties, and by definition includes all money that isn't the firm's. Rule 2.1 clarifies that client money is any money relating to regulated services delivered to a client or held as trustee or stakeholder, or for fees and unpaid disbursements before a bill is delivered. Under Rule 2.3, client money must be paid promptly into a qualifying client account, which must be held at a bank or building society in England and Wales. Most firms use a general client account, though some have additional separate designated accounts for particular transactions. Rule 3.2 requires any client account's name to include the word client, ensuring protection of funds if the firm becomes insolvent. There are specific exceptions. A solicitor might not need a client account if the only money held is for fees and unpaid disbursements before billing, provided those disbursements relate to costs the solicitor is liable for, like counsel's fees. The client must be told in advance where their money will be held and that it won't be protected in the event of insolvency, which is why most firms still rely on a client account. Alternatively, a solicitor may use a TPMA arrangement. SRA guidance clarifies the decisions around not operating a client account, though it's rarely suitable for firms handling property transactions or litigation settlements. Solicitors must meet requirements when handling client money. It must be on demand, so typically in an instant access account, and any leftover money should be returned once there's no reason to keep it. A strict prohibition exists on using a client account as a banking facility. The SRA warns against the risk of money laundering in insolvent clients, as well as noting that solicitors are not regulated in the same way as banks. The SRA's warning notice and related case law, such as Fugler's LLP versus SRA, 2014, and Patel versus SRA, 2012, reinforce this rule. Separating client money from business money is a key principle. The firm typically has a business bank account and a separate client account. Mixed receipts inevitably arise. For example, a bill payment plus future disbursement sums in a single check or electronic transfer. Rule 4.2 allows paying such mixed receipts into either account, so long as prompt transfers follow to allocate them correctly. Historically, the 2011 rules mandated paying mixed receipts into the client account, but the 2019 rules permit either route. In practice, it's still more prudent to pay them into the client account first. To pay fees from a client account, a solicitor must first issue a bill or written notification of the costs. Money for already paid disbursements does not count as client money and can be moved without issuing a bill. This point is clarified in the SRA's guidance on taking money for costs. Because the definition of client money applies only to unpaid disbursements, funds covering disbursements the firm has already paid belong to the solicitor, not the client. Withdrawals of client money must have appropriate authorization and supervision, with the solicitor confirming enough funds belonging to that client exist. Rule 5.3 prohibits the use of other clients' funds to cover a payment, preventing shortfalls. If a breach occurs, Rule 6.1 instructs prompt correction, typically meaning immediate reimbursement by the firm from its business money if client money was wrongly withdrawn. The SRA expects these issues to be fixed as soon as possible. Firms must also pay a fair sum of interest to clients under Rule 7.1, though they may agree otherwise in writing. Records and reconciliations. Rule 8.1 outlines that the solicitor must keep separate client ledgers for each matter, detailing money received and paid on both the client side and the business side. A cash book must be maintained for all transactions through each client account, ensuring a complete record is kept and posted in date order. Every 5 weeks, the solicitor should obtain bank statements for all client and business accounts and reconcile them to the firm's own records, investigating differences. There must be a central record of bills. The SRA's guidance encourages double-entry bookkeeping systems, suitable physical and technological controls, and separate records of interledger transfers. Firms typically have computerized accounting these days, but must ensure the security of electronic records and the ability to produce an audit trail. A notable point arises in residential conveyancing, where the solicitor often acts for both buyer and lender. Under the old 2011 rules, the firm could record the lender's funds on the same client ledger as the buyer's. The 2019 rules don't explicitly say so, but the SRA telephone helpline advised that one ledger can still be used for the buyer and the institutional lender, so long as the firm maintains a clear audit trail. Joint accounts and clients' own accounts. Solicitors sometimes hold joint accounts with clients, for instance when acting as a co-executor of an estate. Although Part 2 of the rules does not apply to these accounts, solicitors must still obtain statements every 5 weeks and keep a central record of any bills. The SRA's guidance highlights the potential risk if either party to the joint account acts without the other's knowledge, so it suggests carefully managing the signature mandate. Occasionally, a solicitor operates the client's own bank account, such as when appointed under a power of attorney or as a court of protection deputy. The same monthly statement and reconciliation requirements apply, unless it's impossible to obtain monthly statements, in which case the solicitor must make reasonable checks to ensure the money is safe. The SRA's guidance suggests keeping a separate record of transactions undertaken on that account. Third-party managed accounts. Rule 11 spells out how firms can use TPMAs. Money held in a TPMA is not client money, so many of the usual obligations don't apply if you go this route. A solicitor who doesn't hold client money at all need not have a client account or comply with those sections of the rules. However, the solicitor must still follow Principle 7 by acting in the client's best interests and relevant paragraphs of the SRA Codes of Conduct, ensuring the client knows the arrangement. Under Rule 11.1b, clients should understand the contract with the TPMA provider, including any fees. The solicitor must verify that the money in the TPMA is used only for its designated purpose, and statements from the provider must be regularly checked. Accountants reports, storage and retention. Most firms need an accountant's report every year, within 6 months of the accounting period's end, but not all must deliver it to the SRA. If the firm has held or received client money, operated a joint account or a client's own account, the accountant must examine the records. Certain thresholds apply to exempt small sums or purely legal aid money. The SRA's guidance helps accountants decide if a report is qualified, meaning significant or persistent rule breaches that put client money at risk. If the report is qualified, it must be delivered to the SRA within 6 months of the period end. The accountant must be from a recognized chartered accountancy body and could be disqualified if they fail to exercise due care. Rule 13.1 says accounting records must be securely stored for at least 6 years. By setting these obligations, the SRA ensures an external check on the firm's compliance, helping maintain public confidence in the profession. Key point summary. The SRA Accounts Rules 2019 form a crucial part of the professional conduct framework, primarily safeguarding client money. They apply to solicitors, firms, and employees, controlling everything from how money is paid into and out of client accounts, the separation of client money from business money, record keeping, reconciliations, and dealing with breaches promptly. They also ensure solicitors produce fair interest for clients, follow strict withdrawal conditions, and avoid using a client account as a bank. Firms are monitored through yearly accountants' reports, especially if breaches are serious or persistent, and must retain records for 6 years. Mastering these details is essential for SQE's success and for ethical legal practice in England and Wales. Thank you for staying till the end of this presentation. Have a look around Dr. Yannis's YouTube channel for more key FLK content.